Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rezolve AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. And make sure to check out this special 14-day trial link below in the description for StockOracle.
Right, and just as a quick disclosure, that is an affiliate link.
Yeah, so the channel may earn a commission at no extra cost to you. We do need to mention that StockOracle is an AI-aided stock research platform. It is not financial advice, it's not a trading signal service, and it's not real-time market data.
Exactly. And always remember that StockOracle's AI insights and valuation estimates can be incomplete or wrong, so, important facts should always be verified by you.
Definitely. Do your own homework. So let's jump right in. Physics, gravity is a constant. You drop an apple, it hits the ground.
Right.
But in the artificial intelligence sector of the stock market right now, gravity seems completely optional.
Oh, absolutely.
We are looking at this financial landscape where the narrative of infinite growth is just colliding head-on with the cold, hard math of profitability. And today, we're unpacking a total masterclass in that exact contradiction with Rezolve AI, ticker RZLV.
Yeah, Rezolve AI operates at this fascinating intersection of extreme optimism and just terrifying cash burn bad. I mean, it's wild.
It really is. For anyone watching this AI boom and trying to figure out how to separate, unaudited promises from actual evidence, this is the ultimate wealth-building context.
Right, because top-line revenue claims in this sector, they can define an entire investment cycle. But as an investor, when you look under the hood at the actual machinery of the business, you often find a structure that is entirely dependent on everything going perfectly in the future.
Exactly. So let's talk fundamentals, because the headline numbers they're throwing out are just staggering.
Unbelievable numbers, yeah.
Right. Rezolve AI recently announced their preliminary revenue for the first half of 2026 is hitting approximately $127 million.
Which is, let's put that in perspective. In the first half of 2025, they reported $6.32 million.
So that's nearly a 20x increase.
Yes, year over year. It's a 20x jump. And management is doubling down, right? They're reaffirming a full year 2026 guidance of $360 million.
Wow. Okay, so a 20x jump in top-line revenue for an enterprise software company. That's a hyper-growth anomaly.
It really is. It signals to the market that a product has moved past, early adoption and into massive scalable deployment.
And the market usually rewards that velocity, right?
Exactly. It gets a premium valuation, which helps explain why their current market cap is hovering around $1.05 billion.
But top-line growth is only half the equation here. And this is where that gravity problem really begins. Because I was looking at their trailing 12-month profitability metrics.
Oh, yeah, the margins.
The net margin stands at negative 299.83%.
Basically, negative 300%.
Right. And their earnings per share is negative 62 cents. They are burning cash at a rate that just completely dwarfs this new revenue they're claiming.
Yeah, the unit economics are a genuine puzzle. Because if you look at the gross margin, it's actually sitting at a very healthy 69.5%.
Okay, so the core software service isn't being sold at a loss.
Exactly. The fundamental product generates strong gross profit. But to hit a negative 300% net margin, the operating expenses, specifically research and development along with sales and marketing, they must be astronomical.
I like to think of it like running a high-end bakery, right?
Sure.
Where a cake costs $3 to make and sells for $10. Great unit economics.
Right. Nice profit on the cake.
But then you realize the rent, the marketing, and the staff cost $40 per cake.
Yeah.
How is that sustainable?
It isn't. In traditional SaaS models, when you scale revenue by 20x, your fixed costs spread out. You gain operating leverage.
You actually start making money.
Yes. The fact that Rezolve is scaling revenue so aggressively while keeping this deeply negative net margin suggests they are spending an absolute fortune just to acquire these enterprise contracts.
Which brings us to the real elephant in the room regarding that $127 million figure.
The word preliminary.
Yes, preliminary and, crucially, unaudited.
That's the big one. Unaudited revenue in the software industry can be incredibly slippery.
Because the recognition rules allow for a lot of interpretation, right?
Exactly. If Rezolve is signing massive multi-year contracts and trying to book a huge chunk of that revenue up front,
instead of spreading it over the life of the contract.
Right. Then that $127 million might look very different once an independent auditor applies strict accounting rules. This is why third-party analysts are totally flagging this stock.
Yeah, I saw a headline from Seeking Alpha that literally said, the story is compelling, but the evidence is not.
And simply, Wall Street is questioning if they can even justify that billion-dollar market cap. Until an auditor signs off, investors are basically just taking management's word for it.
So if the financials are this chaotic, there has to be some major catalysts coming down the pipe or some massive technological thesis holding this whole thing up.
Well, there is. Rezolve AI positions itself as an AI commerce infrastructure layer.
Okay, so not a consumer app.
No, they're building the plumbing. They connect consumers, merchants, and financial platforms. And they have three core tech pillars: brainpower, traceware, and auditable AI.
Auditable AI. Let's unpack that one because I was digging into their partnership with Zilch, and this seems like the real catalyst for the stock.
Oh, the Zilch partnership is massive. It brings Rezolve's concept of agentic commerce to 6 million customers.
And we're talking over $3.3 billion in annual transaction volume, right?
Exactly. And agentic commerce isn't just a chatbot suggesting shoes. It's an AI authorized to negotiate a price, apply a credit line, and execute the transaction completely on the back end.
But to let an AI spend real money, you absolutely need a system that doesn't hallucinate.
Which is the fatal flaw of most AI right now, the black box problem. If a regular AI hallucinates and offers a customer a 90% discount by accident, that's a catastrophe for the merchant.
Right, so auditable AI claims to solve this by providing a deterministic paper trail. The AI literally has to show its math at every step.
Yes. If they've actually solved the hallucination problem, that is a legitimate, highly valuable moat, and routing $3.3 billion through it validates that at least one major financial player trusts them.
But that moat is still early stage.
Very early stage. And they're up against trillion-dollar tech incumbents.
Right. So we have this amazing story, but let's pivot to the technicals. How is the market actually bracing this tug of war?
The price action is a paradox. Right now, the stock is sitting at $2.64.
So it's down, what, about 68.8% from its 52-week high?
Yeah, the high was $8.45 back in September. But it's also up 29% from its recent low.
Including an 11% bounce just over the last 5 days.
True, but you have to look at the volume. The trading data shows the 10-day average volume is way below the 3-month average. We're in a 0.48x volume regime.
So this recent bounce happened on really light trading activity.
Exactly. It wasn't some massive influx of institutional money buying the narrative. It's a low-energy drift, which usually isn't a reliable trend reversal.
And the craziest metric to me is the stock's beta. It's negative 0.18. So it basically ignores the S&P 500 entirely.
Yeah, a negative beta for a tech company this size is super rare. It marches completely to the beat of its own press releases.
Highly idiosyncratic.
Very much so.
Okay, what about sentiment? Because there is a fascinating wrinkle here with corporate insiders.
The insider buying is definitely a constructive signal. Over the last 90 days, insiders bought 95,600 shares.
And zero sells, right?
Right, 0 sells. That gives them a perfect 100 on the management sentiment indicator.
But let's scale that. 95,000 shares at roughly $2.60 a share. That's about $250,000 in insider capital.
Which is nice, sure, but for a billion-dollar company, a $250,000 buy doesn't really set a structural floor on the price.
Especially when you compare it to the major risk we haven't talked about yet, which brings us to the bear case.
Oh, the capital allocation mystery.
Right. Shareholders just approved a capital reduction to enable a share repurchase program of up to $300 million.
Yeah, this is genuinely baffling.
Okay, explain this to me. A company with a billion-dollar market cap that is deeply unprofitable, with a negative 300% margin, wants to buy back nearly a third of its own stock. Are they putting this on a credit card?
Well, they might be. Since they are a UK company, they can't just buy back shares. They need distributable reserves, which means realized profits.
Which they don't have.
Exactly. So they have to get a UK court to approve a capital reduction, basically converting accounting line items into reserves.
Doing a $300 million buyback while you're burning cash like this is like taking out a second mortgage to buy your own furniture.
Great analogy. The optics look nice, but the foundation is crumbling. The big risk is the funding source, which hasn't been disclosed.
Right, so if they issue convertible notes,
then they are quietly diluting the stock on the back end to buy it on the front end. Or worse, taking on toxic, high-interest debt just to prop up the stock price today.
So the multiple is embedding huge expectations. The price to sales is nearly 20x.
Yes. If the audited financials reveal that the revenue is low quality, or if this buyback is funded by bad debt, this stock faces a severe derating.
So it all comes down to the next few months. We have two binary catalysts. First, the UK court approval for the
We
buyback.
need absolute transparency on how that's funded.
And second, the release of the audited first half 2026 financials.
That's the moment the narrative collides with the auditor's pen. If the audit confirms the $127 million and shows a path to fixing that negative 300% margin, the stock could upgrade.
So what's our final verdict here?
Currently, the rating on RZLV is a 5, so it's neutral. It is a textbook asymmetric setup. High upside if the audit proves the moat, but asymmetric downside risk if the narrative fails that audit test.
Yeah, in the stock market, top-line growth is just an exciting story until the bottom line makes sense and the auditors actually sign their names.
Exactly. Finance is supposed to be math, not magic. And it leaves you wondering, in an era where AI companies are racing to show unprecedented growth, how much of this broader AI boom is built on unaudited preliminary figures just like this? Are we valuing companies on reality or just the audacity of their press releases?
Man, that is the question of the year. Keep questioning the numbers behind the narratives, everyone. And again, if you found this breakdown helpful, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link below in the description for StockOracle.
Right. Thanks for joining us on Smart Wealth with Joshua, and we'll catch you on the next one.